All right, I think that might do for now. I think we'll jump into it and kickstart today's webinar. So again, welcome and g'day, ladies and gentlemen. Appreciate you all turning up for Zoom today. Obviously, a bit of a change rather than the go-to webinar model that we usually use. Most people today are tuning in from Australia, the United States and Southeast Asia, just based on the time zone. So thanks for jumping in. If you have any questions, again, please do drop them in the question box. You should all be able to see that now, and we'll get to them at the end, and we'll kick into today's webinar. So again, today, it's put on by Atlas Mortgages and Henderson Advocacy, talking about the Australian housing and lending landscape. You'll be able to see your other panelists or hosts just on the screen there as well. We'll jump into it. So a bit of a disclaimer before we kick started. So anything you hear today, it should not be construed as personal advice. Everything's general in nature. If you do need specific advice about your situation, whether it's, I suppose, investing in property, the right type of mortgages, or any general tax advice as well, please reach out to us directly. We'll be happy to help. But in the meantime, today is general information only, not construed or to be taken as personal advice. Kicking into the agenda today. So firstly, we're going to have Jeremy Harper, Managing Director for Atlas Mortgages. He's going to be giving us an insight in the Australian housing and lending landscape, discussing some micro and macroeconomic factors that are in play, as well as the opportunities and challenges for Australian expats. I'll be talking about a few tax-related items. So my name, James Ridley, Atlas Wealth Management, discussing the main residence exemption, some capital gains tax, land tax, which is a bit of a key theme that's been developing probably in the last 18 to 24 months. A redraw versus an offset account. I think that's an important takeaway when it comes to debt structuring and preventing tax leakage as well. We're then going to hand it over to Jack Henderson, Henderson Advocacy, who's going to be talking about current buyers' sentiment, interest rates, price growth, giving us a bit of a wrap up there as well. And then we'll dive into Q&A at the end. So who are your panel hosts today? So just a quick one. So on the left-hand side, we can see Jeremy Harper. He's the Managing Director for Atlas Mortgages, been helping and assisting Aussie expats and I suppose general Australian tax residents as well with their mortgages for a number of years now. Jeremy also used to live over in New York with his partner, and he was also writing Australian mortgages while he was over there. So he's very match fit to be having those conversations with expats because he's lived it himself. In the middle, we've got myself, James Ridley, Managing Director for Aipac, Atlas Wealth Management. So we assist our clients with those overall wealth strategies. And then on the right-hand side, we've got the Managing Director and founder of Henderson Advocacy, Jack Henderson. Jack's been a property investor for a number of years now. He's personally built his own property portfolio up to just over 17 million now. And he's also built a team along the way of more than 20 employees that help their clients source the right type of properties depending on their goals. I'm now going to hand it over to Jeremy to kickstart into the Australian lending landscape. So Jeremy, I'll just kickstart you onto the next slide.
Perfect. Thanks, James. Good morning. Morning, everyone. Hope everyone's well. So firstly, I wanted to talk sort of broadly about the money market, more importantly, the RBA. It's been everyone's front of mind conversation. So quite recently, the start of this month, the RBA did increase the central cash rate by 25 points. So now the central cash rate is sitting at 35 points. More importantly, that's the first increase for 10 and a half years, which is a long time. You know, so for a lot of borrowers, this will be the first time that their mortgages will be going up. So that will definitely impact sort of sentiment around people's appetite around mortgages and what that's going to look like in terms of repayment in the future. I know, for myself personally, this will be the first time I'll see an increase on my own mortgage, and that's actually going to start to filter through to most banks effective tomorrow. So they met at the start of this month, and then most banks have increased the full 25 points on your variable loan. So as I said, we'll start to see that impact borrowers with a higher repayment as of tomorrow and going forward. There's obviously a lot of talk around, was the RBA going to move before the election? We've got the election this weekend. They've moved before, and now there's potentially another increase in the June meeting, and then we'll see what happens later on the year. So I just wanted to also overlay that so you can see where historically the cash rate has been, even pre-COVID. And if you look at that graph on the left-hand side, particularly around that sort of 2018, 2019 period, the RBA did cut rates, and this was pre-COVID. And people may or may not remember that was sort of as a result of APRA coming and tightening the lending space for investors. And so that really slowed down the sort of overall mortgage market. And what the RBA did was come in, cut those rates to sort of stimulate that activity. And then, as you see, we had historical low rates heading into COVID, and then we went down to 10 points. On the right-hand side, I also find this graph quite interesting because it shows us a comparison around, what are some of the major markets doing internationally. And I guess in Australia, probably the one that we focus on is what's the US Fed doing. And so coming, outside of 2019, they really cut down that central rate to zero. But now they're in a cycle of increasing, and they increased their central rate by 50 points back in March, and there's anticipated further rate hikes. But if you look at that as a historical, it's still low cash rate in terms of going back a decade plus or coming out of the GFC. Next slide, thanks, James. So focusing sort of more on the mortgage side around Australian households, what I like about this left-hand graph here is it's showing where the variable home loan rates have been over the sort of last 4 or 5 years. And then on that right-hand side, we've got, what's happened to the fixed loans. So if you look at starting at the fixed loans on that right-hand side, we could see coming into COVID, the new cost to borrowers for those 2 and 3 year fixed loans went all the way down from sort of that 3.5-4% down to that sort of 2% and even sub 2%. So why that happened? Well, when COVID occurred, the RBA stepped in and said, we're going to put together this term funding facility, and that allowed the banks to basically access cheap funding at 10 basis points, turn around and lend that out to borrowers at sort of 1.5-2% fixed loans. So that's why you can see that a cost of a new fixed loan back in 2020, 2021 coming down to that 2%, over 2%. But since then, the RBA has turned off that funding facility, and that's increased the costing for fixed loans, or the cost of funding for the banks. And that's why you can see from September last year, really up until sort of even now, and before the RBA moved, they were increasing the cost of new fixed loans to borrowers. And so I think it's really important. What gets lost in the conversation is people will assume that the fixed rates are correlated heavily to what the RBA does. And yes, that is a function, but the internal banks have their own pricing, and that is a function of what does it cost them to get those the funds for those fixed loans. And so with the RBA turning that off, it's increased the bank's cost, and that's why, even at the start of this year, you're seeing fixed rates going from 2 to 4% as a new cost to borrowers, and that's separate to what the RBA has done, because as we said, they only moved sort of at the start of this month. But interestingly, if you look on the left-hand side with the variable loans, that has come down. So even prior to the May meeting with the RBA, we're actually seeing historically low variable rates on the backdrop of fixed rates going up. And that might be a function of it's still costing the banks, for that type of funding for variable loans is still low. Cost of deposits for customers is still low, which is correlated to the RBA. But that is separate to what's happened to the fixed rate. So in the media, up until sort of recently this year, a lot has been recorded on the cost of the new fixed loans coming up. But another function of that is we have seen coming into, before we were seeing these 2% fixed loans, historically Australians would be taking sort of 30% of all mortgages would be fixed, and the other 70% would be variable. And when these super low fixed rates came out, it was actually becoming 50% of all mortgages were fixed. And so I think by reducing the variable loans, the banks are trying to get customers back onto a variable loan and potentially increase their margins, which is in line with when the RBA makes their movements. And so just on the right-hand side, you can see there on the fixed housing interest rates, that just, again, it shows the advertised rate on that purple of the cost for new owner occupiers on that fixed rate. You can see that spiking this year to reflect that. Next slide, thanks, James. So this slide here, it gives a bit of an overview around the households in Australia, and there's a few things that stick out for me that are really interesting is the orange line consumption. So that's measuring what is the consumption of households, and you can see they're coming into the start of lockdown at COVID. That dips down to a negative growth, and then it shoots back up very quickly up to sort of 10% plus growth, and that was on the back of a lot of government stimulation, giving people money to basically get through COVID, giving businesses money. So that's driven that consumption level. And then you can see the disposable income growth is sort of normalized. But the other thing I think is really important to understand is that savings ratio. So in line with Australians tightening up on the consumption, leading into COVID, you can see the savings ratio on that red line really spikes up. So 18% plus as a factor, and then it starts to come down as the economy opens up, people start spending, they've now got less savings, but you can still see it starting to sort of jump around there. But I guess what that's showing us is despite coming out of COVID, the lockdowns, the government intervention, people not spending, people spending, our savings ratio still as a household and as an overall economy is still stronger than the rate was coming before COVID. So I guess that shows that any interest rate increases, households can weather that. They've got the balance sheet to get through that. So I don't think that's going to impact sort of people's mortgage repayments and arrears that some people in the media are sort of anticipating. Next slide. Thanks, James. And this slide here, so what I like about this is showing as an overall market, the housing loan commitments, so excluding refinancing. So basically this is showing us what's the mortgage market growth as an overall aggregate broken down between investor loans, owner-occupied loans, and as a total. And so the interesting things here is you can see in the orange line, which is owner-occupied, and you can see going back to sort of that 2020-21, there was an owner-occupied driven growth. So last year, a lot of that property growth was driven by owner-occupied buyers, and that was a part of the super cheap lending that we talked about, the fixed loan. So customers go in, getting that 2% 3-year fixed loan, taking out a new mortgage to buy something to occupy. And since then, you can see that starting to come off that demand, but that was at record growth sort of May in 2021. And then since then, the investor loan, actually, you can see at that same time, that was starting to soften off. But actually right now, the investor growth has taken up. It's now at historical levels. So investor lending has never been so high as aggregate new lending, and the owner-occupier starting to come down off those historical highs. And I think APRA, who governs what the banks do in terms of their policy and capital requirements, they weren't as concerned last year around the owner-occupier growth, because the way they look at owner-occupier mortgages, it's typically P&I. Typically, historically, people will make other adjustments if rates do go up, but they're more concerned on the investment side. So what we're seeing here is APRA is now starting to step in with these banks, and we're seeing more of this. This started sort of late last year, and it's becoming more of a theme now. And so there's a thing called a Dti Cap, so debt to income. And what that means is you may be able to service that new investor loan that you want, not a problem, with your income less your expenses and outgoings, but the bank is now mandated to say, look, we can't go over a DTI of 6, which is basically telling borrowers that there's a factor of your total income for the household as aggregate. How many times can you borrow over what you're trying to achieve in terms of new borrowings and established borrowings as a factor of 6 times your income. And there are ways that every bank has different treatments around that, but this is becoming more of a theme around sort of APRA-governed lenders. So you've got your ADI lenders that are starting to put this in place. So by having that DTI cap, you will start to see investor lending, people start to hit sort of their limits, which has happened previously. So expect to see that more of a theme this year and next year. Next slide, thanks, James. So some macro and micro trends just to talk about, and this is some trends that have already occurred and some that may continue to play out. Obviously, Australia's response to COVID there's a lot of media, state versus federal, but looking back as a whole, people would agree that Australia on a world stage has had a very good health response, and that has carried through with business confidence, employment, very strong employment numbers, and consumer confidence. And I think Australia has looked like a sort of an economy that is something that people could aspire to either do business with or move and be part of that economy in the future. And that, I think, also plays into the fact that returning expats. So, we've had something of around 400,000 expats have returned since 2020, and there's still an additional 50,000 due to return back into the country. So what does that look like in terms of property demand? Are they going to occupy current investment properties, or are they looking to buy something that they're going to live in on return, or in the future when their plans are to return back to Australia for the family home? Record interest rates. Yes, we've seen fixed rates go up over the last 8 months, and the cash rate is now at 35 basis points, but historically the variable rate is still in the totality of the history at record lows or close to record lows. So that is still meaning that the cost of a new mortgage on the variable side is still at that low points, but that trend has been changing. So on that fixed rates side, we've seen 200 plus basis points increasing on those 2 and 3 loan tenures. So there will be some challenges there for clients or borrowers that were on those super cheap 2-3 year fixed loans. When they mature, what repayment will they have at that point? So when that reverts to variable, or they try and go and refix it in 2 or 3 years' time, they will be on a higher interest rate. System inflation. So this, I guess there's been a lot of talk around inflation, and James might talk about this a bit later, around those core input items. So your fuel, building materials has had a huge impact on the cost of building, which filters through the cost of dwellings. Fruit and veg has all gone up. So this will be a challenge I see for the RBA around how do they increase rates to manage inflation, but also how do they manage the Australian economy? Because if there's core items that families can't cut back on, fruit and veg to have your meals, etc., and they're cutting back on the discretionary items, what does that impact to the economy? Because if people are spending less in the economy, that's going to filter through to jobs, demand for business, and that will change their confidence. Increase in savings. So I talked about that earlier around that savings rate. Although we've seen lockdowns, government interventions with new support, we're still coming out of COVID with a higher savings rate. So that will still make households confident in terms of borrowing and their prospects into the future. A renting class. So this is something that unfortunately has been playing out. So if you're on this call and you're a landlord, then you may understand that some people are locking themselves into long-term renters, unfortunately. And so we've seen some really good government programs coming out there to help people get out of renting, get them into their first home. But with the pressure of inflation, with the pressure of the interest rates through the RBA and on landlords' investment mortgages, you're going to see the rental demand increase. There's going to be a squeeze. It's happening. It's happened this year. I'm sure Jack can talk a little about this later. And people's rental expense as a renter is going to go up, which unfortunately is going to create more people and struggling to get out of the rental game to buy their own house. So I big supporter of some of these government programs that have come out, some of the first home loan deposit schemes to get people into their first home. And I hope that there's more done in this space. And then finally, there's this upsizer owner occupier boom. And so you're seeing a lot of people with the tree change that did play out last year, moving to the regionals, selling their house in Metro Melbourne, Metro Sydney, the big cities, cashing that in and then buying something on that lifestyle type house. I think that will continue. I also think it'll be interesting to see as we come out of COVID and what does the working from home versus in the office look like. I think that will start to change a little bit more and people want to be closer back to the cities, which will be a change in that trend. Next slide. Thanks, James. So talking more about expats, because you're probably more interested in this, what are some of the sort of options available for expats? You can obviously refinance, restructure your loans. You can so when I say restructure, you might be on a loan term that's, say, investment loan right now, it's got 10 years left on it, you're paying P&I. You're happy with the loan, you don't need any additional debt, but perhaps you want to extend that out to 20 years from a cash flow point of view. So that is an option. You would need to sort of sit down, we'd look at that, but also reviewing your loans. I know looking at a lot of clients, they are stuck on higher rates, and people do assume that because I'm an expat, I have to pay a higher margin. Yes, that's the case with some banks, just the way they price the loan, but there are better deals out there. Some people have, properties crossed. They might have a couple of investment properties. Look at uncrossing those. If there's part of a strategy that you want to offload a property into the future and you don't want to have to deal with having the properties crossed, which can cause issues down the track. Purchasing investment properties, yes, that's very much the case. Provide you've got equity in existing property in Australia, we can do an equity release, access that equity as a deposit for the next property. And I think that's really important if you're a non-tax resident, and James will talk on this more, but around the gearing. So if you've got one property at the moment that has positively geared and you're paying Australian taxes on tax on that net income, what does that look like if we take out equity on the existing property and basically do 100% gearing on that second purchase? Does that offset some of that taxable income? Renovations, extensions. So this has been, really big. I think this is smart. So people taking out equity to either renovate the house, which they can re-put on the market and get a higher yield for rent. A lot of people looking at, say, doing extension, maybe putting a granny flat on that same dwelling, or looking at my next point, doing a duplex, triplex on that property, subdividing it, turning that, getting a couple of different renters in there. All of a sudden your yield goes up exponentially versus that one dwelling. Of course, that's something to think about on the backdrop of building costs going up. Just making sure from a numbers point of view that does make sense, because some clients have been caught out with, taking a fixed build contract, they've got the builder, and then they've had to sort of revisit that contract just because the cost of building materials have gone up so much, and then that's delaying projects. So that is an option, but you just have to be a bit more patient, because sometimes that's going to take longer than what it would have taken a couple of years ago in terms of getting a new build done. And then finally, looking at purchasing that forever home. So perhaps you want to take out an investment loan. This is the house you want to live when you and the family come back in 4 or 5 years' time and you're done being an expat and you want to, be close to the beach in Sydney. Yes, that's something to do. Rent that out for now, and then once you move back in, get that converted to an owner-occupied home loan. So that's something you can do once you're actually back in Australia. Next slide, thanks, James. And then finally, just want to talk about some of the opportunities and challenges. So I just talked about some options as an expat, but opportunities and challenges. So as I said, access to record low interest rates. And again, some people make the assumption because you're an expat, that comes with some sort of margin tax on top in terms of interest rates. Not the case. There's a lot of lenders that will give you an investment rate exactly the same as if you're based in Australia, which is great. So there's no penalty there. If you're an expat and you're in a low or no tax jurisdiction, fantastic for you, well done. Australia is not that case, but you can use that tax-free income and start to really eliminate some of that debt that you take out for investment purposes. Great strategy, particularly if it's going to be, as a forever home, that when you do come back to Australia, that mortgage is either eliminated or very manageable, and you've got that dream house. Start or continue to build your investment portfolio, as I said earlier, create some passive income for retirement in Australia. If you've got a couple of properties and then they're basically paid off when you get back to Australia, you can use that rental income. Some challenges. So as I was saying earlier, APRA is coming in. They want to start to muddy the water again. So we're going to see more of that DTI restrictions. And so that's just going to be a case of working with a broker. Okay, what are some of the challenges? Which bank? Because every bank has a different policy. They'll change all the time. Who will have this restriction? Who won't? How do we navigate that? Higher deposits required. So if you've got existing property in Australia, that's fine. We can potentially use equity, an existing property. But if you're starting out and this is your first property, you're going to have to aim for that sort of 20 to 30% deposit plus the closing costs, so your stamp. So if it's, say, a 30% deposit, really aim for sort of 30 plus 5, so 35% of that purchase price. Lending is generally restricted to employee income, which might not be a problem for most expats. There are some banks that will accept self-employed. So if you're running a business overseas, that is an option. But our lending sort of options on that particular is restricted. So we just have to navigate through that. Non-citizen spouses. So this is a big one. If you're living overseas and your partner is a non-resident, so they've got no sort of visa status in Australia, and you're wanting to buy property in Australia together, there are some hoops that you have to think about. There's additional stamp duty, which is at the state level. Obviously, FRB, the federal level, you'll be exempt if you're married or in a spousal relationship, but that stamp duty is punitive, so it's an additional, depends on the state, but sort of 7% on top of your regular stamp duty to consider. So that's just something to work through in terms of, do you wait until your spouse has some sort of citizen status, PR, and those things can take years to work through. So that's just something to kind of be mindful. Or do you look at just putting that property in the Australian citizen's name? And then the other challenge is just making sure you're working with a good team. So obviously in this type of market, it's just making sure you've got the right people around you to help you through that. And I think there is a little bit of trust that needs to go into that system because you're overseas. I do see a lot of people who want to DIY the property search, and this is probably a bit of a shout out to Jack, which is totally fine. And they're getting mum or dad to play sort of quarterback real estate agent / buyer's agent, not a problem. But I often see that turns into being a 12 plus month project, and time is money sometimes. So what does that look like in terms of engaging a professional to help you out with that? So that's just my experience that I've seen. So yeah, that's probably the real challenges I see coming through here. And that's it on my spot, James.
Yeah, mate, that was great. Very insightful. A few questions have filtered in through that sort of segment, so we'll address those towards the end. Again, ladies and gentlemen, there will be a recording made available. It will be going out just on sort of the email list if you're registered. So I've had a few people just send me a quick chat asking that question. So a recording will be made available. If you've got any general questions, please do submit them. We're going to do a bit of a Q&A at the end, just in case you arrived late. We'll kick into my segment now. So mainly going to be talking about tax considerations with property and Australian expats, just need to knows and ways that we can prevent tax leakage in the event you're selling property and potentially upsizing or upgrading, changing your strategy. So we'll jump into it. First one I want to talk about is the main residence exemption. So a little while ago, they announced in the budget back in 2017 that they were going to remove the main residence exemption for expats, and that did go ahead. And that's why I've just got that note there, the removal date, 30th of June, 2020. Right now, the main residence exemption, it's a tax concession which we get for living in our own home for a period. When we move out of it, we can then choose to rent it out for up to 6 years, and it doesn't accumulate any capital gains tax with the ATO at all. That 6 years is tax-free, it's exempt, which is great. We're earning income off it, then we have a decision to make. We keep renting it out, go over the 6 years, it starts accumulating a bit of capital gains tax, that's okay, or potentially move back into it. So the benefit of moving back into it for a period is just the case that we can actually reset that 6-year rule. So it's under the assumption we don't buy another main residence, because we can only technically have one main residence in the eyes of the ATO. But it is a benefit that we can lean on depending on your property strategy, whether you're resetting, say, the 6-year rule on maybe a really good blue chip asset or blue chip house in a good area. You can keep that tax-free for as long as possible, depending on your situation and your flexibility to relocate and those sort of things. It's what's, I suppose, quite unusual and pretty common, I guess, with the ATO when it comes to clarity on certain things. On the ATO's website, you won't find a specific text or rule which states how long you have to move into a property to actually establish it as your main residence. So it can sometimes be a convoluted topic when you're asking different accountants or, I suppose, tax lawyers. But based on legal precedents from the past, there's a bit of a threshold rule around the 6 months. When you look at a lot of state revenue offices and the first homeowners grants that they give you, one of their rules is that you live in the place for a minimum of 6 months generally, and you move into it as soon as possible. So that's a really good takeaway there. Obviously, Australian expats or expats returning, if they're buying a property soon, but they're not returning for 3 or 4 months, that's okay. If it hasn't been rented for the 3 or 4 months, well, you can still establish it as your main residence, and it wouldn't have sort of accumulated any capital gains tax. So it's important to be mindful of that. So they removed the main residence exemption for expats, but the key takeaway is that if you sell a property now while you're overseas as a non-resident, then yes, you no longer can access that benefit. But the key takeaway is at the time of sale, what your residency is. So I will commonly get asked the question about, well, what does it take to resume residency? It's a really good question. It's one of the rules that they're looking at updating in the background right this second. New residency rules are meant to be legislated as of 1st of July 2022, and they're meant to provide additional clarity and almost make it to a degree easier to resume your residency with the ATO in Australia. But yes, the MRE, it was removed back on the 30th of June for 2020 for expats. So it's just being mindful that you probably shouldn't look to sell a main residence if you're overseas and a non-resident, because unfortunately the CGT implication of that can be quite large. There are ways you can reduce it, but it can be quite large if you've held that property for a number of years. There are some circumstances which you can get out of that CGT event, and it's mainly the significant life events, i.e. you've been diagnosed and you're terminally ill, or your spouse is terminally ill. Potentially you're going through a divorce or separation, so you can get a court order there to exempt you from the CGT. And lastly, either yourself or a spouse passes away. So those are the significant life events which have ruled into that. But it's just a really important takeaway when it comes to the main residence exemption. Remarkably, I still talk to expats this day that aren't aware of this legislation change. And they find out sometimes when it's too late. They've already settled, and then they're sort of finding out that they're going to be stung with a big tax bill, and then somewhat got to scramble for a way to reduce it as well. So just wanted to touch on that on today's slide. I'll move into the next slide being capital gains tax. So in Australia, we don't have different capital gains tax rates. I know in the US, you definitely do when you've held an investment for more than 12 months, and some regions don't even have capital gains tax. A key example is Singapore, very lucky. In Australia, a capital gain is just treated as ordinary income. Therefore, we pay our standard income tax rates on the gain. However, we do get the ability of accessing some concessions. So as an example, for an Australian tax resident, and we've held an investment for more than 12 months and sell that investment as an ordinary Australian tax resident as well, we can access this 50% CGT discount concession. So you can use this concession for the period of ownership on a property up until the day you leave. So that's really good. And then when you leave, you can access it and still access it through a market valuation. Unfortunately, though, the government did remove this concession back in May 2012. So it just means that if you've held properties for a very long time back in Australia, you can still access that concession. But if you are needing to, say, release one of those properties and sell it, well, it's in your best interest to look at getting a market valuation as of the 9th of May 2012. If you've left Australia, say, recently, and you've held a property for the last 10 years, well, that's fine. You'll still get the benefit of that discount concession up until the date that you've left Australia. But it was a key change a number of years ago, 10 years ago now, wow. Unfortunately, it just means you need to be mindful if you're choosing to sell properties whilst you're a non-resident or for a period of ownership whilst you've been a non-resident. But again, there are ways you can reduce your tax exposure there, but it's always best to consider segregating different periods of residency versus non-residency through market valuations. There's really easy platforms out there to access market valuations. Unfortunately, the ATO requires an accredited valuer. They won't allow sort of, a Ray White real estate agent, as an example, to just give you a one-page letter. They want it accredited, and that'll hold up a bit better. Some of the examples of the platforms you can access online if you ever need a valuation. Option Solutions, they're really good. They've got a really big expat audience. I believe BNTQS, that's another one, so it's Bantax. But they can just do an online valuation using historical data. In terms of cost for valuations, it depends on the property type and how historical you're going. Most expats, the furthest back that they need to go will only be May 2012. Kick into Next slide being land tax considerations. And this is a key theme which has been developing over the last 18 to 24 months. And I'm not sure yet as to why this theme's been developing. I put it down to some data feeds are starting to link up between council officers, state revenue officers as well. So when we look at land tax considerations in general, over the last 5 years, there have been some real changes on land tax liabilities that come out annually from each state. The biggest change mainly is that if we're an Australian citizen or a permanent resident, we don't get slugged with these penalty rates. So those are the big changes that have come into effect over the last 5 years. Previously we were considered a foreign sort of holder, or an absentee surcharge would kick in. Those can still kick in, but the thresholds are much higher now, which is good. Land taxable value versus market value, very different. So you might have a property, I'm based on the Gold Coast, so if I've got a property that's in Burleigh Heads and it's worth, say, $1 million, on the open market, well, the taxable value of that land might only be 300,000 or 350,000, and annually it'll change. You get a letter sent out to you, but our threshold in Queensland is quite high, 599,000. We're quite lucky, to be honest. But most states, they'll have a land tax minimum threshold of 299,000. If it's your permanent place of residence, your main residence, well, you're exempt from that land tax bill, which is good. It's mainly applying to investments. When we look at different state revenue officers, they also have different, I suppose, rules around tax vehicles that you hold property in. So right now, probably the one of the worst would actually surprisingly be, not worse, that's probably not the right word. I think if we look at the minimum threshold, if you're buying property through, say, a trust, the minimum threshold, or a company, I should say, in Victoria, is 25,000, the taxable value of the land. So it means that, yes, you'll inherit a land tax bill pretty quickly when their minimum threshold is 25,000. So it's just making sure that as part of any, say, property strategy you might follow, using the correct tax vehicles, so you're not getting slugged with huge land tax bills. One of the main key things that I just mentioned before was, and again, I think it's because the data feeds are somewhat playing catch up, but when we move overseas and we have a main residence, one thing that we should be looking to do is updating the change of use. We don't usually do it. We get a letter and we sort of forget about it, but changing the use of that main residence from main residence to now an investment property. If we don't do so, eventually a state revenue office can catch up with us and say, okay, we realise you've been renting out this property for a number of years now, but you've only just, you've kept it as a PPR. So that means there could be some outstanding land tax bills due for the last couple of years. And the interest charges that they whack on those outstanding bills going back a few years, they can be quite significant. The interest charges, they're not like indexation on, say, a HEX or a help loan. They're sort of close to 8 to 11% depending on the year. They're quite high. But I just wanted to emphasize that if you're unsure and you already own property or you're about to rent out your main residence or anything like that, have a look on the State Revenue Office to see what your use and whether you should update it or not, because you don't want to stick your head in the sand and just forget about this and get a funny letter in 5 years' time, which has been a little theme that's been developing. Using an offset over a redraw. So a good slide, and again, I'm mainly looking at the offset on this side about just trying to structure things correctly. So it's very common when we've been an expat for a number of years and we're coming back and we're looking to buy a property, we might and very likely relocate to a new city or choose to upsize, purchase a new home. If we can get it right and our debt will be structured correctly, it means we remain very tax efficient. So an offset account, just a quick summary here. And Jeremy, feel free to chime in and correct me if I'm wrong. You're the mortgage guru. So yes, an offset account, it's a separate non-interest bearing account linked to the mortgage. Every dollar placed into the offset reduces the interest expense on the actual principal amount of the mortgage. When returning to Australia, funds can be pulled out of the account to use for the main residence purchase. That's great. Because you're using it for the main residence purchase and it's coming from the offset account, then the interest expense naturally will go back up on that loan. But that interest expense that's going back up on that loan, that's all 100% tax deductible because it's tied to the old main residence, which is now an investment property. So One of the hardest things to do is, yes, structure your debt correctly on return or buying your future main residence, where, yes, you might have to refinance on the old property, pull out the equity, use it as the deposit. That's unavoidable naturally. If you're using an offset account compared to a redraw account, that means your debt will be structured correctly from a tax deductibility perspective. If you're pulling funds out of a redraw facility, because the redraw facility is just on the principal loan amount, it's not a separate account, it's actually on the loan itself, and you're pulling the funds out and you're buying a main residence, because it's not an income producing asset, you won't be able to claim the tax deduction on the interest expense going back up. It's one of the pitfalls. If you're pulling funds out of the redraw to use for, say, another investment property, well, that's fine. That's an income producing asset, all 100% tax deductible. If you're pulling funds out of the redraw to buy shares when you're a normal Australian tax resident, that's fine. Interest expense still 100% tax deductible because it's an income producing asset. It's an investment. So really just wanted to emphasize that, just because it can help you focus on your timing when you come back to Australia. There can be a pitfall about loading up our offset accounts though. And one of the pitfalls, which Jeremy alluded to earlier, was, well, because it's reducing our interest expense and our tax deduction, it can create this scenario where we have a positively geared property. Positively geared property is not a terrible thing. As a non-resident, you do have high tax rates though. So it's being mindful of this and making sure that, you're doing everything in your power to keep building wealth in a tax efficient manner. And I suppose when we look at preventing tax leakage, it's always going to be a fundamental aspect as part of a wealth accumulation strategy. When it comes to property, depending on the event that's taking place, there are a few ways that you can prevent, I suppose, additional taxes or income taxes. So we'll look at a bit of an example. So, we've all heard the concept, ideally, of negative gearing. Big concept in Australia. It can be quite fruitful for reducing income taxes. Negative gearing is a strange concept, though, for expats, because you don't have anyone here paying tax on your behalf. It does give you the ability to accumulate income losses, though, which can be a future benefit that we'll reap the rewards from. Now, positively geared property, yes, it's just that. After when you stack up the income versus all the relevant tax deductions, the net income still exists. There's still a bit that you're receiving. That's good. As a non-resident, though, your income tax rates can be a little bit higher. Unfortunately, as a non-resident, we don't have an income tax-free threshold. We pay tax on the first net dollar at 32.5%, so a rather high tax rate. So one of probably the easiest ways to help reduce that, a positively geared property, is depreciation. We've all heard ideally of depreciation. It's a non-cash tax deduction, and it just helps reduce, obviously, our taxable income, not necessarily our actual cash flow income, but our taxable income, which is different. And it can reduce our exposure to that 32.5% income tax. I've just put there a note, please note, cost-based resetting effect. Now, what that means is that every year you're claiming depreciation, just bear in mind that depreciation on an annual basis that you're claiming, if you're having to sell that property in the future, it will reduce the original cost base. But if you're in the property game and your strategy is just accumulating sensible properties along the way to build up your passive incomes, you're not going to be worried about that resetting cost-based effect at all. It's not relevant. You're just reaping the rewards of the non-cash deduction. The other way that we can reduce income tax from a positively geared property is a super contribution. So right now, when we consider contributing to super and expats, there's a lot of myths out there. We can't touch super. We can't contribute to it. We shouldn't contribute to it. I'll admit there are some rules around that depending on the country that you reside in. I know the US, it can penalise you quite heavily, but just wanted to preface that, yes, you still can contribute to super depending on where you are, and understanding whether it's the right fit is usually when you need advice. Reaching out to either us, an accountant, to understand whether it's going to be a benefit. But the benefit of contributing to super is that rather than paying the income tax rate of 32.5%, your super is only paying 15%. So you're saving yourself a very quick 17.5%, which is great. And it's a very easy strategy. You've got one asset paying into a retirement asset. That's great. There are some eligibility requirements around it, but you do have the benefit and option to do so. The next example I was just going to talk about is sale of an investment property and I guess probably every investor, every strategy is knowing when to let go a poor investment because at the end of the day, if you bought in an area where it's gone backwards, or maybe a very old mining town somewhere out in the middle of nowhere, and that town's dried up, unfortunately that can happen. So it's knowing when to release an investment, but there are still options to reduce your exposure to capital gains tax as an investor. So the first two, carry forward capital losses or carry forward income losses. Carry forward capital losses, they might have come from a CDT event in the past where you actually realised the loss. Carry forward income losses, they might have been generated from an already negative geared property strategy that you've been running. So you can use that to reduce a capital gain, and that can help reduce your tax as well. The last big, I suppose, opportunity we have is there's a legislation piece which came into effect as of 2019 financial year in Australia. It's known as the catch-up concessional contribution. So it allows you to pool pre-tax contributions unused from 2019, 2020, 2021, 2022, a rolling 5-year period. In the current year, it means you can actually create a very large tax deduction for yourself of $102,500. Very beneficial if you only want to pay a 15% tax on your capital gain. If it's a property that's jointly owned, well, that's great. That's already a capital gain that's obviously worth $205,000. If you've held it as a normal tax resident, well, $205,000. If you apply the 50% discount, that might be a property that you realise a gain of $410,000. As you can see, it has this compounding effect where it can add up and you can make a very large savings there. Next year, you'll be able to actually create a very large tax deduction of $130,000. I will add, though, there are criteria around the eligibility to make that kind of contribution, things like your superannuation balance, your age as well, working. So if you're unsure whether you need to employ that kind of strategy, well, it's best you reach out to, whether it be your accountants or obviously a financial advisory firm like ours, just to see whether that kind of strategy makes sense. So those are the items that I want to talk about today, just in terms of preventing tax leakage. I can see there's a few questions that come through as well. That's great. I'm now going to hand it over to Jack just to talk about Henderson advocacy, views on the market as well. I'm now just going to flick it over and we'll kickstart into that. Over to you, Jack.
James, a lot of gold in there, mate. Thank you. So as James said, I'm a buyer's agent. I was a property investor first. And essentially what we do for our clients is we help them build out property portfolios. We've helped a lot of James and Jeremy's clients. So we help them from, the start of their journey, building out the strategy, and that's what Jeremy and James do best, is obviously the mortgage side of things, making sure you're structuring your loans correctly. James is great on the wealth management side, obviously reducing your tax, and then we help with actually getting you to the end goal of wherever you want to be, and making sure that you're buying the right assets, and making sure that you're not getting caught up in all of the jargon that's going on in the media from one day to another, which I'm sure a lot of people are seeing at the moment. So James, can you just click to the next slide, please, mate? Awesome. So I'm sure most people who are tuned into the Australian media at the moment, now obviously COVID is no longer a main topic in the media. They've now moved to the interest rate rises and all the uncertainty that's out there in the global economy, and obviously in the Australian economy. And what that's obviously doing is changing the sentiment out there in the marketplace, especially in the property market. And when there is uncertainty, that's when I strongly believe, and our clients believe, that's what creates the most opportunity. And if you look at one of the biggest investors in the world, Warren Buffett, he had his first quarter, the biggest quarter of his last 10 years of investing in the first quarter of this year, where he deployed $51 billion worth of capital. And that was because of all of the uncertainty out there in the marketplace. And I'm sure anyone who's in tech and all the rest of it sees the massive opportunity that there is in tech shares. And we're seeing the same thing in property, and that's because of the buyer sentiment change. And we were seeing this back in January as well. So, materially, the interest rates have obviously just increased, and they've increased by a very small amount in the grand scheme of things. But 3 or 4 months prior to that actual increase, nothing had materially changed anyone's situation, but the sentiment in the marketplace had changed because everyone was predicting and waiting for this interest rate increase, and then also the looming election that's this Saturday in Australia. And as soon as the chatter in the media changed, obviously that's when buyers started sitting on their hands. They started waiting, and obviously what that then does is flows on to the vendors in the marketplace, right? Because if vendors see that there's less buyers in the marketplace, then obviously they start to get more realistic on their pricing. They start to hear the chatter that, oh, maybe our property will be worth 10 or 20% less in 6 months' time. So maybe it's time for us to sell, and maybe it's time for us to sell at a price that we definitely would not have sold at 3 or 4 months ago. James, you just want to flick the next one for me, please? Awesome. So obviously the chart there is showing the consumer sentiment index, and it goes back from May 2006, which is obviously just prior to the GFC, through to May of 2022, which is where we're sitting right now. And as you'll see, there is ebbs and flows all the way through, that sort of 16 years or thereabouts is what it's showing. And as you'll see in the GFC, the buyer sentiment was extremely low. The sentiment in the global economy was extremely low. But if we look back now and reflect on that time, I'm sure at the point in time it would have been very, very scary to buy a property. But looking now forward 16 years, properties that were purchased in the heights of the GFC have probably tripled in value, or potentially a little bit more, depending on where you purchased. And then if we look through, until May 2020 there, May 2021, again, there was a slight dip in buyer sentiment when the start of COVID happened and all of the uncertainty was out there in the marketplace. And again, properties that were purchased in that time have probably now doubled in value. And if you would have just slightly missed that, dip in buyer sentiment and then maybe jumped in late 2021, the percentage returns on that particular investment would have actually been dramatically different, because the marketplace rebounds extremely quickly as soon as certainty returns. And that's where we're seeing the opportunity right now, because at the moment we're at the height of the uncertainty in the marketplace. We've got a very uncertain future in terms of interest rates and what's going to happen there. Obviously, when people are predicting things, generally they predict them to be much worse than what they actually end up being. We obviously have an election that's coming up this Saturday. Not that that's going to have a dramatical impact on, whether Liberal or Labor get in on anyone's personal situation around property, but again, it creates more uncertainty around the marketplace. And I'm sure when the election happens, there'll be even more uncertainty. So we're seeing right now, when there's the peak of uncertainty, that's when the best buying opportunities are actually out there in the marketplace. So if you look at the text up the top there, the overall value of the residential property market, obviously it says 9.9 trillion there. It probably depends on the day that you value it. But if we're talking just shy of $10 trillion and our actual debt against that value is only $2 trillion, the overall LVR on our Australian property market is sitting at roughly 20 to 25%, which is extremely low. I know if I had a personal property portfolio with a 25% LVR, it'd be extremely positively geared and I'd be sitting in a very, very strong position. So again, sort of saying what James and Jeremy have already said, people are very good at making things seem a lot more dramatic than what they really are. But the reality of the marketplace is that if we've got a $10 trillion property market and a value of $2 trillion, even if we did see a 10% decrease, which is the largest decrease in property that the Australian property market has actually ever seen on the Australian property market, we're talking about wiping $1 trillion off, and we're still sitting at somewhere between a 30% to a 35% LVR. And just over the last 12 months on the overall Australian property market, we've seen just under 24% increase. And in the first quarter of this year, it was just under a 5% increase in property prices. So again, when we're seeing these things in the media of 20% decreases and 10% decreases, or whatever sort of news publication you look at, when you then compare it to the increases we've had in a very, very short period of time, they're actually not that bad, and they've actually got to materialize for there to be any impact. And another thing that I don't think a lot of people understand is that obviously interest rates are not the only contributor to property price growth, and then obviously property price decrease in Australia. And if we flick to the next slide, James, we'll see some pretty interesting data. So this is the last 6 times that the RBA have increased the cash rate in Australia, back from 1994 to 2009-10, when the last cash rate increase was. And something that you'll see is that every single time the cash rate is increased, property prices have actually followed them and continued to increase. So what that shows us is the correlation between interest rates and property price growth. Sure, there is somewhat a correlation, but it's not the only driver. And if we obviously then remember back to the buyer sentiment graph, you'll also then see when the buyer sentiment was extremely strong, that's obviously when the house prices and all the Australian property market prices continue to increase. So right now, where we're in a time where there is likely to be more interest rate increases, there is likely to be a lot more uncertainty in the marketplace, there is likely to be a stronger constraint on inventory. But we're seeing this now as probably one of the strongest times to buy, because as soon as normality returns into the marketplace and people, see that a 0.25% increase or a 0.5% increase or a 0.75% increase over the next, say, 12 months isn't going to have a huge impact on their overall scenario, and there's likely to be a lot of other things they cut out of their life and not paying their mortgage, that opportunity will start to evaporate as a whole. And we will start to see a lot more buyers jump back into the marketplace, a lot more vendors be a lot firmer on their price and not being willing to negotiate as much as they are right now. And you're obviously then going to be buying property in competition and not necessarily in isolation, where a lot of the smarter buyers are buying right now. And what we're seeing as a company with Henderson Advocacy is we work with home buyers spending, $400,000 in some markets in Australia, up to sending tens of millions of dollars. And over the last sort of 2 years, a lot of our high net worth clients haven't actually been buying a great deal of property, unless it's been an owner-occupier home. They haven't really been investing. But since the shift in the marketplace and since a lot of the buyers have pulled back, I've had numerous calls and meetings with a lot of high net worth clients that are now saying, we're seeing the uncertainty, we're seeing the opportunity out there in the marketplace. We don't want to obviously rush this, but we want to take advantage of what's actually happening out there and hopefully be able to buy something, 10 or 20% cheaper than what we would have been able to buy it November of last year. Next slide, if there is a next slide, James.
Next slide, we're actually going to move into a bit of Q&A.
Into the Q&A.
Yeah,
and I think that's where, I'll be able to add the most amount of value, because obviously people generalise the property market in Australia. There's hundreds of micro markets inside of Australia, and they all perform very, very differently. So it's if people have got specific questions around different markets, whether it be Brisbane, Melbourne, Adelaide, Sydney, I think that's where the value is.
Absolutely, mate. And thanks for that. I mean, the questions that have been filtering through, there's a few here, which is good. I think quite a few attendees will get some good nuggets out of these. Some of them are the sort of, they're actually quite specific to us individually, which is really, really good. So if you have any questions, throw them in. As you just heard, Jack's happy to provide his 2 cents on, I suppose, different markets as well, especially the next 12 months in a rising interest rate environment. So let's have a look. Actually, this question is mainly for me, so I'll jump into it. So what does it take to resume residency to sell a main residence? That's a good question, and it's not something that's clearly defined even by the ATO. Resuming residency, it's mainly surrounding your current habits. I would say that most accountants would say in order to resume residency based off the current old tax residency rules, they want to see you in Australia for more than 183 days. They want to see that you've returned to sort of a permanent place of abode, or you have a rental in your name. They want to see all these little sort of data points. You've got electricity in your name. You've got a job. You've confirmed with the ATO that you're a normal tax resident again. You sort of put yourself back in the system. If you're trying to sell a property just to benefit from the main residence exemption, but you're physically only here for say 4 months, unfortunately the Commissioner for Taxation, he'll lean on Part 4A, which is the anti-avoidance rule, and they can audit you for up to previous 4 financial years, I believe, which means that they would look right through that, especially if you've gone again. The new residency rules that are meant to be coming through very soon, we are still waiting for an explanatory bill around them. There's a lot that's still going to come from those. They haven't actually released an explanatory bill, which is a bit nerve-wracking and given that it's meant to be legislated as of 1 July 2022, and they keep referring us to the Board of Taxation report, but that was submitted in March 2019. Not really suitable for a world that's just gone through a pandemic, where sometimes we can be forced into a lockdown. Look at China right now as an example. We can't really leave the country. So there's a lot that's still going to come out. Resuming residency, I think a safeguard and a conservative answer would be a minimum of 6 months. And that's essentially just hitting that 183 day mark in the same financial year. This question I'm going to throw over to Jeremy, and this is about foreign property. So can I use foreign property as collateral? So can I use a foreign property and pull equity out of it to purchase back in Australia? Will an Australian bank let me do this?
No. Australian banks will be limited to securities based in Australia.
Yeah,
that's where, because they lose their legal jurisdiction once you start going to different countries. So they've got to be able to sort of cite the property that they want to take security over.
Okay, that makes sense. Can't really obviously place security. This is another question for you, Jeremy, probably pretty much aligned with when we've actually spoken. Jeremy, in your experience, are there any countries which banks won't consider if an Aussie expat is residing there?
So the hard no is, and I don't know the exact government department, I think it might be under DFAT, but obviously if the country is listed as a, friendly with terrorism, so there are some countries listed there through money laundering. If you reside in those countries as an expat, that's a no. Mm-hmm. So you'd have to check that. In terms of, is there certain countries, it depends on the bank's policy. Some banks will prefer to only look at expats with sort of the gold star currencies, US dollars, pounds, whereas that's in their particular policy, where some banks are open to looking at clients in the various countries and not restricted by what currency is. But a lot of that is dictated by the government around the anti-money laundering and terrorism. So have a look at that website.
Yep. I'll give you a breather, Jeremy, and I'll throw this to Jack. Jack, it's mainly around Henderson Advocacy. Does Henderson Advocacy assist with any type of property, or do you have a select type of scope that you do with property, or is it sort of any type of property, any type of client?
It's a good question. So the lowest purchase price is probably around 400 grand, I would say. And like I said earlier, the highest purchase price can be tens of millions. That's generally for owner-occupier properties, not investments. But it really comes down to the individual client, right? That there isn't, especially when investors start young in their journey, they're generally not on the highest incomes they're going to be on as they go through life. And that obviously is going to be reflective in their borrowing capacity. So, especially as first home buyers at the moment, we're actually helping a lot of first home buyers taking advantage of the first home loan deposit schemes and things of that nature, where they can spend up to say 700,000 in New South Wales or parts of New South Wales and regional hubs. Get into the market with a $35,000 deposit, don't pay any lender's mortgage insurance and not paying any stamp duty, and they're in the property market. And if you actually look at the returns on a $700,000 investment, for example, with only putting $35,000 in it, a lot of people, when they look at property investment, they look at the overall return on the total value of the property, not the cash that they put into the deal. So, we had an example recently where we bought a $650,000 two-bedroom apartment in a beachside location. He put $30,000 or $30,200, I think it was, $32,000, into the deal. Got that property revalued within 6 months at $810,000. So that was about $160,000 return on, his essentially investment. But the growth actually wasn't 30% on the property. The growth was actually 500% ROI on his initial cash investment, which is, pretty incredible. So we help a lot of those kinds of investors.
Yeah. That's great, Jack. I'll throw it out to Jeremy now, this next question. More of a personal question, but I think, Jeremy, you might be able to answer it pretty easily. So my husband and I returned to Australia October 2020. We own a home in the USA, both semi-retired, casual work at the moment. Is there a way for us to get a mortgage age 74 and 64? Are credit societies or mortgage lenders a better option than a bank? So based on their age and working casually at the moment, being semi-retired, how would they go getting a mortgage?
So yeah, there's a fair bit in there. It depends if they're trying to buy something to live in or investment, and then it will come down to what age you plan to retire, and then your exit strategy for that mortgage. So if it's owner occupied and you're planning to retire in 5 years' time, well, typically the bank will want to have that tenure aligned with your retirement age, because for owner occupied purposes, they don't want really you to have a mortgage outstanding when you hit age of retirement, because they don't want to come in and take that property. If it's an investment property that you're buying, and again, you're planning to retire in 5 years, it will come down to your exit strategy. So the bank may allow a longer tenure on that. So from a serviceability, it might become a little bit easier, provided you've got other assets outside of that property to take care of that mortgage. If you wanted to liquidate and pay down that mortgage, you can. So if you've got no other assets, it's going to be a struggle depending on your age of retirement.
Okay. Sorry, that was not an easy question. I thought it might have been. I'm going to another question for Jack. Jack, with your firm, Henderson Advocacy, do you mainly focus on certain hotspots, or do you do all around Australia?
It's again, a good question. We don't do any hotspot investing. So everything that we buy for clients and all the investing that I personally do, one of the biggest things that we look at in a certain area is that it has a proven track record of performance. So, if we can look at a data set that shows us 20 or 30 years of that area, or that SA3, which is a statistical area 3, which combines a lot of LGAs, we can say it's got 30 years of a proven track record of consistent growth, then that's the first data spot. And we go, okay, well, now it's worth us actually looking into. But a lot of areas that we invest into are generally quite close to major CBDs. The majority of them are on the eastern seaboard of Australia. Some of the other important aspects we look at is making sure that the people who live in the area, or the demographics of the person, earn high incomes or higher incomes than the Australian average. And that's because obviously the more you earn, the more you can generally spend on property, which will increase the values of properties over time. Making sure that the areas are owner-occupier dominated as well, because owner-occupiers in Australia are the ones that buy with emotion, and that actually drive price growth. And 70% of the buyer pool in Australia is actually owner-occupiers and not investors. So if you invest in an area that is driven by investors, obviously when the marketplace shifts and the buyer sentiment changes, like we were just chatting about, generally the growth in that area dries up and you generally see declines, which is what we see in areas like mining towns and other hotspots. So yeah, proven track record is very, very important when buying any property, I strongly believe.
Great. And another question for you, Jeremy, and it's a question about fixed rate loans. So fixed rate loans over 15, 20 or 30 years, not common loan products in Australia. I think that's because they do them in the US. Jeremy?
Correct, yes. I think US, UK, you can lock in for 15, 20 plus years. So Australia, most banks will go out to a 5-year tenure in terms of fixed loans. There's a couple of the banks, ANZ CBA can offer a 10-year. If you look at the actual reference rate on those loans, it's outrageous. It's probably sitting about 8-9% right now that you need to lock that in. So there's a huge difference to what the variable rate would be.
Yep. No, that's good. I'll answer this next question. So it's mainly just targeting me. It's about, so James, historically, when the interest rates increases, the AUD increase as well. There's a lot that goes into our currency. So we're a commodity currency. Our currency is supported a lot by commodity prices. And through the start of this current calendar year, commodities have obviously done quite well, unfortunately brought about by mainly the geopolitical event, Ukraine-Russia. However, you've also got to bear in mind that the US dollar, or the US, it's a bit of a safe haven. It always has been. It's the major trade currency. So when markets are nervous, you'll have a lot of traders and investors flood into the US or the USD. That naturally causes our currency to weaken. So when you look at currently our interest rates are rising, we've entered a tightening cycle. The only reason our currency would weaken further would be if we didn't move on interest rates and commodity prices dropped. That would be a case where the Australian dollar would weaken, but that's not going to happen. Very likely, commodity prices will stay quite buoyant, and interest rates are moving. So there's not a widening gap anymore between, I suppose, the US and Australia. Naturally, the US, with inflation over there, will have to go a bit higher in terms of their interest rate movements. We won't, but I guess when you look at the gap, we are increasing. So the gap shouldn't, I suppose, widen as much as we lift our rates as well. We're starting from a very low cash rate at the moment. So I would say the Australian dollar, I'd be surprised if it weakened further. But again, there's a lot that goes into the Australian dollar. It's not a simple, straightforward answer at the moment. I'll now turn over and throw out another question for Jeremy. It's about self-employed. So can a self-employed person, expat, get a mortgage? Are there some standard requirements around it? They've asked whether they need tax returns as an example.
Yep. So you can, as I said earlier, a lot of banks, it's a no, but there's options out there. So typically it needs to be 2+ years in operation. So if you're, 8-month startup, no deal. And it will come down to sort of the net profit over 2 years minimum for how you've gone. So verified through tax returns. So if you're in the US tax returns, and depends on the bank, potentially like an accountant's letter to confirm that income as well overseas. So ideally it makes a bit more sense if you've got an accountant that does your books as well to help out with verifying that income.
Yep, great answer. I've got a good question here from Chris. Honestly, this might be one Jeremy and Jackie both weigh in on. So how would you weight buying a property now versus in 3 months' time, assuming that allows you to make an increased deposit but would need to take on an increased loan rate? So under that assumption, you might be locking in a fixed rate now. So how would you weight buying a property now versus in 3 months' time? That allows you to make an increased deposit but would need to take on an increased loan rate. What are your thoughts on that?
Oh, so
Jeremy, you share first, and then I'll.
Well, I guess that question is probably making the assumption that the fixed rates today versus in 3 months' time will be higher. As we've seen, the fixed rates have already filtered through. So if that question was asked September last year, yes, that makes sense. But I guess there's no guarantees that there's going to be exponential increase in fixed rates from now to 3 months' time.
That's
if
right.
it's a variable loan that you want to take out, and between now and 3 months' time, well, it doesn't matter if you take out the loan today or in 3 months. Being variable, you're going to get what's happened through the RBA and what the bank's passed on.
Jack, your thoughts?
Yeah, and obviously I'll share it more around the property side of things than the mortgage side. But generally what we say to clients is that there's obviously when you're predicting into the future, there's so many variables, right? Like so many things can happen between now and in 3 months' time, some positive and some negative. And all we really know is what's going to happen right now, right? So what I would usually say is if you're in a position to buy the property right now, you're in a position to cash flow the property for the short to medium term, and you've got a 5+ year horizon in which you're going to own it, then there really has never been a better time. Because it's all about selecting the right asset as opposed to trying to time whether now or in 3 months is going to be a better option. And a lot of people did that back at the start of COVID, right? It was like, oh, we're just going to wait and see what happens with this job keeper and job seeker. And then it was, all of a sudden 3 months come and something dramatically different happened as opposed to what we thought was going to happen, which was the market took off instead of coming back. And I'm not saying that's going to happen in 3 months' time, but there's just so many variables, and I'm someone who doesn't really leave much to chance. And I'd rather a definitive answer right now where I know I can afford it and I know I can buy a really good quality asset and there's less buyers in the marketplace, as opposed to potentially what can happen in 3 months.
Next question. I'll address this one. It's around tax residency. So will the new residency rules penalise property ownership? And they've said re-factor tests. So the new residency rules, the way they're proposed is that if you return to Australia for more than 45 days in the Australian financial year, you then need to satisfy 2-factor tests to accidentally trigger your Australian tax residency. However, there is an interaction with the tax treaty of that country as well. So it's not a straightforward answer, but within the factor tests, there's right to reside in Australia. So that's a permanent citizen, permanent resident or Australian citizen. That's Australian accommodation. Australian accommodation is a main residence or that's not rented out. As part of the Board of Taxation's report, they even said a timeshare, a holiday or a ski chalet, which is a bit ridiculous. But that's the ATO and Board of Taxation for you. Another one was Australian economic interests. So Australian economic interests, they put in the Board of Taxation report, it can be a bank account with as little as $10,000 in it. There was brief mention of a superannuation account. So most expats would comfortably be able to satisfy residency rules if, I suppose, residency, if those new rules are legislated. As part of the explanatory bill, which has not been put together yet, they need to flesh out all these factors and provide exact clarity on what it includes. Even ties to a discretionary trust in Australia was considered an Australian economic interest if you're a beneficiary. So, and there might be people out there that don't even know they're a beneficiary as part of a discretionary trust until they finally receive some income. So yes, they need to flesh those residency rules out. Not a straightforward answer. Having ties in to Australia, such as a bank account with $10,000, well, it's a lot less than a property worth $500,000. That's still going to capture most Australian citizens that return for that period. Again, it has not been legislated. We are still waiting for the explanatory bill to come out, which very unlikely we'll see that in the next couple of months, given we've got an election going on. We all go to the polls this weekend. I'll move on to another question now. Again, throwing out to Jeremy. Jeremy, don't know how you'll answer this one, but Jeremy, are there any specific lenders that you're using for excess at the moment? Would you care to share? Question mark. It's probably a bit of a tongue-in-cheek question, I would say. But any
type of lenders? I'd say we use a variety, probably generally outside of the big four, like your mid-tiers, just because they offer a better deal and their policy is a little bit more flexible at times for expats.
Yep. That's great. And then just another question, I believe for you, Jeremy, and it's mainly around policies on currencies. Got a few expats here tuning in from the US, Singapore. Do banks have different policies on currency, as I have an option to be paid in US dollar or Singaporean dollar, SGD? Is one preferred over the other?
They're both pretty sort of standard mainstream currencies, so that's not going to really penalise that person too much. What the banks would look at in terms of some of those smaller currencies, yes, some won't accept it, so you just would have to look at the options. But it's more around some banks will convert that income to Aussie and apply Australian tax rates on that, and some will convert that to Australian dollars net of tax. So I don't know if there's going to be different tax treatment based on the currency being paid, probably not. But if there's a material difference and the lender will look at your net of tax position for loan servicing, yes, that can make a difference to your borrowing capacity.
Okay, great. Question for you, Jack. So suppose handling some advocacy, you help me source a property. Do you also have services that help me remotely manage short-term rentals, e.g. Using the Airbnb listings?
Personally, or inside of our mother company, we do not, but we obviously have a lot of companies that we work side by side with. So when we do have clients that are doing it for short-term rentals like Airbnb, we obviously refer them to a company that we use personally that will manage and take care of all that side of things. But again, it's pretty straightforward in terms of getting someone in, getting someone out, cleaning the apartment, and taking the rental income. It's very similar to a full-time rental, except they clean the apartment.
Yeah, agree.
Can I just jump in there and just give a 30-second story? When I had Airbnb in Melbourne, the final point for me was when I had to deal with the AFP, the Australian Federal Police, because one of my Airbnb guests was, trying to rip off people through ATMs, and he trashed my apartment. So yes, the yields can look good versus a long-term tenant, but it was just not worth it in the end. So anyway, that was my little story.
Jeez. Okay. Another question here. I think this one probably mainly for me. Can you purchase property in Australia as a trust with family members that live in Australia permanently if you live abroad in the US and then rent out the property? So, I mean, based on that, it would be an investment property through, say, a discretionary trust, and you'd be a member. You can do so, absolutely, because you've got Australian tax residents, which might be the trustee of the trust itself, which is good. Central management control still held in Australia. The only item I'll add there is the US or the IRS has some very unique rules around foreign trusts. So it might require an additional tax return being lodged to the IRS, even though you might not have had any income come through to you because maybe the property is positively geared. But yes, you can do so. It's just setting up correctly. And then, obviously having someone that can assist you find the right property, and then start considering things like your land tax, your stamp duty, how that applies if you're a non-resident beneficiary as well, mapping that all out. So I hope that addresses that question. Another question here for you, Jeremy. This one's quite a long one. So I'll try and read it out cleanly and concisely from Richard. You've mainly answered this already about who your preferences are around lenders at the moment, but which lender is the friendliest for non-resident Australian citizen borrowers? I ask this as my understanding is Australian banks impose higher lending interest rates on Australian citizens residing overseas who are considered non-tax residents. So you've already addressed the component about it right now, mainly probably non-big four banks. I think that's probably what you brought. Additionally, my understanding is an Australian bank will discount a potential borrower's salary if it is derived from a non-AU employer. In my case, I live and work in the US. I spoke to NAB a year or so ago. They told me they would have to discount my US salary by about 50% and use only that portion to calculate my borrowing capacity. So, and he's asking the question, is that true? Do they discount overseas salaries? He got discounted by 50%. Is that accurate?
Yeah, well, so speaking specifically on NAB's credit policy with expats, yeah, they take it by 60%, and even their FX rate that they exchange it, most banks will exchange it on a spot rate, sort of what you'd find at today's date or a 30-day average. For some reason, NAB's policy, they actually have a worse FX rate. So if you were to look at your borrowing capacity with NAB specifically, it's not strong, so it's not someone I'd really work with. And actually on their pricing discount tool, if you notify that you're using foreign income, the discount they'll give you on the standard variable rate is less than if you're in Australia. But as I was saying before, a lot of banks will not penalise you in terms of high interest rates. Some banks do, but I don't really work with those banks because why would we go with them and pay a high interest rate? But a lot of them will charge the same investment rates that you would pay if you were living in Australia. And so for US income, most will take 80% of your converted income in Australian dollars, and that includes if you're getting like a yearly or quarterly bonus, as long as that's been paid for a couple of years, that can also be factored into your loan servicing.
That's great. I'll move into another question, Jeremy, again, targeting at you. This is a bit more of an in-depth question just around the economics of everything going on. So, Eugene, so given you assess against the US market, how are you projecting the income and consumption model given talk in the US of a perceived recession coming in 2023 due to spiking inflation rates? I believe I put that right. So I suppose given you assess against the US market, how are you projecting the income consumption model given talk in the US? So I'm assuming this is how you talked about earlier in the slides about sort of the 6 times your annual salary. Is that right, that model? And given inflation is going, do you think that might change if we're sort of going to head towards a bit of a recession in the coming years? Or the US might?
Well, so the banks will do an assessment as the ball lies, so that that you can't say, okay, well, let's do a credit assessment. Here's my income, but I'm going to have to take a 40% pay cut potentially in 2 years' time or next year. That's not how the credit assessment work. If you're looking about in terms of inflation on the living expenses on the US side, so when we go through your living expenses, so obviously what are your expenses today and what are going to be potential expenses. So let's say you're going to buy an investment property in Australia, and we list all your groceries, and your phone bill and your travel costs in the US, and then what do we anticipate the investment property will cost in terms of rates, if it's an apartment, strata fees, insurance, etc., for that property. So we'd factor that in. If you're concerned that, okay, my day-to-day living expenses for the family is $2,000 US dollars a month, but I think it's going to be $3,000 next year, then obviously we can put that in and use those figures as a living expense estimate to use to calculate your borrowing capacity.
That's great. Another question here, mainly for Jack, and just sort of what you see with your current successful clients. So for an expat that's starting out on their property investment journey, who should be in their team? An accountant, broker, buyer with a long-term view of building a property portfolio. So who should be in their team? Who do they need?
James, Jack, and Jeremy would probably be a great start, I reckon. No, so I guess in all seriousness, obviously you can't buy a property if you don't have finance. So you need a really strong broker. And obviously, if you're not living in Australia and you're earning a foreign income, you need someone who understands that, because I think there's a lot of brokers out there, and just like the example we have with going directly to NAB, a lot of people don't understand what the banks offer and what their perfect client avatar looks like. So you need a broker who understands your personal scenario. Obviously, an accountant is absolutely super important. If not every single person uses an advocate, a buyer's advocate either. So I'm not going to say an advocate is a necessity, because it's not 100% necessity, just like a broker is not 100% necessity. But I guess if you value making the right decision and having confidence in your purchase, then a good buyer's advocate on your team is always going to get you further than without. I think overall wealth management, again, is super important, because a lot of people are either generally quite shares focused or generally quite property focused. And I think a well-balanced portfolio is going to weather a much better economy than just being either one or the other. And then, all the ancillaries, so things like good property managers, so people who understand the local marketplace and where your property is if you're an investor, to make sure you're maximising your yield on that property, and they're on the ball when it comes up to people's 12-month tenancy agreement. Is the marketplace stronger than what it was last year? Can we get a little bit more rent, which is obviously going to increase your yield? Can you paint the property or do new carpets or put an air conditioner in, etc., which is obviously going to maximize your yield. So a good property manager, I think, is crucial. And I would say they're probably the main contributors. And then obviously, as you start to get more sophisticated investor, your portfolio gets bigger. Then you can start to plug in other ancillaries, which are going to again maximize returns and minimize any downside that could potentially be out there, or pitfalls.
Yep. Good question and well answered. Jeremy, this question is going to be at you, and it's regarding obtaining finance in Australia. So re-obtaining finance. So Australian banks seem to want me to reduce my US available credit, even if it's not used. And at the US end, this helps me to have a low percentage usage and maintain a high credit rating in the US, but Australian banks don't see it that way. Is this the case for all Aussie banks? So I would assume, high credit limits, that'll be credit cards, those sort of things, which might not be used.
Yes, generally, yes. Most banks take the position of what is your US limit, convert that to Australian dollars. And so when I lived in the US, they would just hand out credit card limits like they were lollies. Mm-hmm. So it's easy to have $50,000, $100,000 in credit card limits on the US side. That becomes Australian dollars, and then they will factor that as an expense, 3.8% monthly. So that can be quite a lot. So it actually can be higher than the mortgage repayment that you're going for. So there's a couple of banks that will have a policy now that will say, if you can show 3 months credit card statements for those limits, they can go off, your average spend over that period, not the actual limit. But most banks will still go on the absolute limit, because they take the position that you can draw down that facility at any time. So part of responsible lending, they need to factor that in. So just like if you had an overdraft facility sitting there on your bank account, that needs to be factored in as an ongoing assessment. So yes, I know on the US side, it might penalise you, but I guess think about what's your goal. If it is to buy a property in Australia and you need to service that loan, then you need to drop those limits for that assessment.
Yeah. This is a bit more of an open question, Jack, a good one to get your feedback on, and it's mainly an expat that's heading overseas, and it says, if you plan on living in the US for, say, another 6 years, or just about to move over there for a 6+ years time frame, do you think it's best to buy an investment in Australia or an investment in the US, and then when you're returning from the US, then buy in Australia? So trying to decide on, I suppose, whether to buy now in Australia, hold as an investment, or whether to buy in the US for a period and then return, then buy in Australia. What are your thoughts on that?
It's a good question. I'm not going to pretend I'm an expert in the US property market, because I'm definitely not. But look, I think time in the market is a lot better than, again, timing the market. So if you've got a strong budget, obviously there's quite a few variables in that question, but if you've got a strong budget, you've got the cash on hand to be able to buy a property, and the opportunity is presenting itself in the marketplace like it is right now, then my inclination would be to buy a really good quality asset before you leave Australia. You're obviously going to have an easier time borrowing money too, because I'm assuming you're earning Australian dollars at the moment and you're obviously an Australian resident. You're going to buy a really good quality asset. You're going to get a strong yield because we've got quite a competitive rental market in most capital cities in Australia at the moment. And then most properties in the interest rate environment we're in, if you put down a 20% deposit, are going to wash their own faces as well, which means it's going to pay for itself. It's not going to have any impact on your overall position from lifestyle perspective. And then you can essentially go to the US and enjoy life and not have to worry about it too much. And if you come back in 6 or 7 or 10 or 15 years time, there's a very good chance that property is going to be worth a significant amount more than what it's worth when you originally purchased. And then I guess you can reassess the situation. If you're going to then spend the rest of your life in Australia, do you then offload that investment and then turn that capital then into an owner-occupier home? Or then do you leverage again that investment and buy yourself an owner-occupier home, or continue to rent vest essentially? So I would personally buy in Australia.
Good question. I'm going to throw this out to Jeremy, this one. So we're returning to Australia later this year. Our employment and income situation will not be as favourable at the time as it is now. We want to renegotiate a better rate on our mortgage. Would we be better off doing it now as an expat with long work and income history, or upon returning to Australia as Australian tax residents? The home will be our principal residence upon return.
It's a good question. So you can we can chat with the bank, see if we can negotiate, and that's something if they can come to the party. Quite often, unfortunately, they will say, no, we can't give you a better option, and then when you prepare to leave and you give them the discharge form, they'll say, hang on, wait, we can actually give you a good deal to hold on to you. If that's not the case and you do a refinance whilst you're abroad, that's fine. You just need to factor in your expenses abroad and your higher income. If you wait to do it in Australia, and it becomes, if you do it abroad, you'd have to do the refinance as investment loans. So investment loans typically sort of 25, 30 points higher than owner occupied, depends on the bank. If you do the refinance and you're occupying the house, yes, you may have lower income, but a couple of things to think about in terms of borrowing capacity. It might be okay because they're going to accept 100% of your Australian income, apply Australian tax rates, and then I'm assuming you might be renting overseas at the moment. That would then get discounted out of your living expenses. So your borrowing capacity washes out. It might still be the same as it is now on a lower income. So if you wait and do it in Australia, then you can refinance at owner-occupied rates, because obviously you can give the bank evidence you're now in living in the property, some sort of phone bill, utility bill to say, yep, we're now back home.
Great. A few more questions, one for each of us. So just this one for me from Christine. So in terms of limiting or reducing capital gains tax liability on the sale of an investment property, never really a PPR, do you have any tips on investing in super to reduce this liability? So yes, as per one of the slides, if you are selling a property and it is going to be a formal capital gains tax event, you've made a capital gain on it. Right now, you can use what's called a catch-up concessional contribution strategy, which does allow you to create a very large once-off tax deduction. I don't know where you are, so I can't speak for the local tax rules, whether in the US or another country, but it's important to understand what that might cause as well, depending on the country that you live in. But yes, you can put in super. It helps reduce your tax significantly. It's just being mindful that there are eligibility requirements around that, things like working age, size of superannuation balance as well. So you can employ a strategy, but you really need to either speak to an accountant, speak to someone like myself or the team, just to do a bit more of a formal assessment around whether that's the right strategy for you. It's also getting down to what your goals are, what you're trying to do, and the end result, what you're trying to achieve. So good question, not an easy answer, something which need to go a bit more into a situational analysis there. I'm now going to throw this one over to, we'll give it to Jack, this one. So Jack, what are your thoughts at the moment on the Perth and Adelaide markets? Have you got any insights onto those areas?
Very interesting question, because a lot of people are asking that at the moment. I don't necessarily like the Perth property market as a whole, and the reason for that is because it's generally quite cyclical and it's very reliant on one industry, and that industry is generally the mining industry. So obviously when the mining industry is doing very well, then generally the property market there is similar. And on the flip side, when it's not doing so well, generally the property market's not doing so well. And again, it goes back to looking at that track record of performance, and you generally with the Perth property market, you'll see that it's a very cyclical marketplace, and there hasn't been a very consistent rate of growth. And I know I'm generalizing here because there's a lot of different markets inside of markets, but overall it hasn't been the strongest marketplace. Adelaide on the flip side, is a market now that's getting a lot of attention from investors, and a lot of the growth that's been derived in the Adelaide property market of recent years is very investor driven, especially the areas that are outside of the sort of immediate CBD of Adelaide, or within sort of the 5 to 10 kilometre radius. And again, that's because of affordability, right? So when you're living in Sydney and Melbourne, when you look at marketplaces like Adelaide, they seem a lot cheaper than what Sydney and Melbourne are. So people go in there, they invest for affordability reasons, but that growth is not sustainable growth because it's not driven by owner-occupiers, it's driven by investors. And as most people in Sydney and Melbourne are earning higher incomes than people are in Adelaide, when the investors pull back out of those marketplaces and then it just returns to the owner-occupiers in those markets, then the owner-occupiers can't actually afford what the property they're now there, and those prices generally come back. And we've seen that in places like Tasmania as well, which is another area that a lot of investors have jumped into for affordability reasons, but the prices will start to come back. So if you are going to invest in Adelaide or Perth, I would always follow the same fundamentals. So be as close as possible to, the CBDs, which is usually where the majority of the wealth and the affluence is. Make sure you're buying a home that has a lot of owner-occupier appeal, making sure you're buying an asset that is in the best quality location that you can be in, and that goes down to the street level as well. And then on top of that, making sure that you buy an asset that has a lot of scarcity to it, because obviously the more scarce an asset is, the stronger the demand will be over time. And, they're usually not making any more of a certain type of home or apartment.
Yep, that's great. I'm just going to change the slide, but there's a few more questions that are just filtered through. Next question is mainly for Jeremy. And this question, Jeremy, we've actually answered pretty recently on our podcast. So quick podcast shout out there. We do our own Expat Mortgages podcast. And this is one we talked about very recently. So with the rise in interest rates and banks looking to pass these on tomorrow, as referenced earlier, is now the best time to be locking in a fixed interest rate on existing loans for a couple of years, ? What are your thoughts, Jeremy?
So the fixed interest rates are priced independent to the variable rates, and obviously banks internally have their own pricing teams. They forward project where they think the market would be, what's the cost of funding to fund the fixed loans. So if we look at it from a pure pricing of where fixed rates are, sort of missed the boat in terms of pricing. That was back in September last year. So if that question was asked back in September, definitely lock it in, lock that rate in. But the moment, if you want to say, no, I don't want to, if you want to lock yourself into a fixed rate now, it's not necessarily about the rate that you're paying. It's more around that certainty to say, okay, well, I'm going to go to a fixed loan for 3 years for certainty that this will be my repayment. But one of the cons of that right now is you would be locking in paying sort of 180 to 200 points higher interest rate on that fixed loan for 3 years than you would on the variable. So I guess the question for that person going back to ask that question was, if you're comfortable to give the bank an extra 180, 200 points on that mortgage, with just the rates are going up by 25 points, so think about that, that's probably another 7 or 8 increases by the RBA. If you're comfortable to pay the bank 180, 200 points more today for that certainty of your repayment of the next three years, you can look at that. Otherwise, you've got to think about the opportunity cost of would you be comfortable to keep it variable and see where the variable rate goes over the next 3 years? It may go higher than an extra 200 points today, or it may go lower. And I guess the question going back is, if it doesn't go higher than that fixed rate that you've locked in today, would you be comfortable with that decision?
Well answered. I think there's been a few more questions that have come through on the chat, but they're a bit too personal, so we'll address those separately. So we might wind it up there for today, ladies and gentlemen. Thanks for joining us, bearing with us. A good long consult and good long webinar there. Plenty of great, I suppose, nuggets out of that Q&A as well. We will be releasing the recording. We'll just carve it up a bit and edit it. We'll be releasing all our contact details, some show notes as well. So that'll come out to your emails in the next coming days. Appreciate you guys dropping in. If you do have any questions or queries, please feel free to reach out separately. Happy addressing them. Thanks for your time, guys. Thanks for stopping in.
Thanks, guys.
Thank you. Cheers, guys.